Hear me? Hey, what's up, everyone? Can y'all hear me? Thumbs up? Yeah? All right. I'm excited to be here. I'm excited. It's 6:30. Feels like it's midnight. It's so dark outside. And I'm super excited because it's the first time that I'm seeing y'all, other than the little live I did a second ago. But um, I've been on vacation 21 days straight. It's typically 30, but I didn't hit my goals last year, so we're here. We're here a little bit early working, getting some work in. So all right, this meeting is being recorded. Okay, we're good. Welcome everyone. I'm very excited. This is the annual State of the Market 2024. We do this every year, and the reason why we do this is because we want to learn from the very best in their industry. And the reason why we want to learn from the very best is because we want to make money. And the way that you make money is by learning from people that have a lot of money and learning from people that help other people who have a lot of money. So today you're going to meet a lot of people who definitely help a lot of people who are multimillionaires, and they see what moves they're making in their specific industry. And that way they could share with us what's going on. And that way we could have that same information. It's all about guidance. We're not trying to figure it out on our own. That's not what life's about. Life's about learning from others and sharing and growing, and we're here to learn. And I'm hoping this time next year you guys come back and say, man, you know what, my net worth grew just like my net worth grew substantially into seven figures, or by more than seven figures, sorry. It grew the last 12 months. And a big part was because I do speak to these people, um, all the time. We always speak and I always ask questions. I'm always learning and growing from them. So let's get right into it. Thank you for joining. Take some notes. Hopefully you guys are like me and you guys have a notepad, right? Where you guys are taking notes, pen and pad, and let's get right into it. So Eli, if you want to go into this slide deck. So here's a little outline. We have a bunch of killers, a bunch of really smart people, a lot of people who help business owners and multimillionaires grow their wealth. And this is what we're getting into today. So let's go on to the next slide, please. Uh, so here's a little bit about myself. My name is Voltaire Lepe. I'm a real estate agent, real estate broker, property manager, property owner, born and raised in San Diego, my entire life in the Logan Heights, uh, greater Logan Heights area. And I have a lot of real estate experience. I have 51 tenants paying me rent every single month. And I've done very small deals and very big deals. And I help a lot of local organizations and community members. I sponsor a lot of kids with their sports and with their education. Let's go on to the next slide, please. By the way, if this is absolutely free. I want everyone to get as much as you can out of this, and I'm sure you will. Please scan this because if you guys could do us a huge favor, if you get something positive from this, if you learn something, please leave us a review online. 5-star review with positive comments. That'll help our business substantially. So this is the review code. I appreciate you guys. And this is all we ask for here. All right, the next one. So first, we're going to have Dr. David Fogel. He's really smart, really smart guy. We've had him on here before in the past couple of years, and we always enjoy his time. He's an internationally recognized scientist and speaker and engineer, and he served on as a director of research in financial service industries for just under a decade. And he received his PhD and master's um, and Master of Science in Engineering from University of California, San Diego, as well as his Bachelor of Science in Mathematics from the University of California, Santa Barbara. All right, so Dr. Fogel, we'll hand you the floor here, and then you can share your screen, and then you could kind of tell us what you're going to show us, and then that way we could follow along. That'd be awesome. Welcome.
I'll be happy to. And I've worked in finance for about 20 years. I've worked as director of research for last decade. but worked in artificial intelligence for 40 years. My dad was one of the pioneers in the field. I'm going to go ahead and share a screen, Voltaire, just so you know it's going to stop your sharing. So,
Yeah, that's awesome.
um,
Thank
yeah, my dad, Larry, passed away in 2007, but he was one of the first people to work on artificial intelligence and machine learning in the 1960s. Wrote the first book on simulating evolution on computers in 1966 with a computer that's as big as my dining room table
you.
and no hard drive. So you can imagine it was way ahead of its time. But
That's
I
amazing.
tried to follow in his footsteps. So let's see what we can do to make sense of the market with the technical patterns that we have and some of the fundamentals that we have that are driving the market using the Thinkorswim platform. So this is going back 1 year. We'll go back and take a longer view as well, but let's start with the 1 year view. So if you follow the financial markets, you probably know that the S&P 500 was up about 24% for 2023 and had a bit of a profit-taking move, I'm going to call it, at the beginning of the year, which is right here with the dashed line. And we've since rebounded back up to a slightly higher high than we had before. Let's explain what each of the things are that we're looking at. Every day in here is a bar. It's a green bar if it's up. It's a red bar if it's down. You can see we had several down days in a row as we started the new year. This is going back 250 some odd days for 1 year's period of time. This is something that I review with ATS and people there consistently for their wealth management decisions. So I'm going to share it with all of you here tonight.
Thank you.
So the first things that we do is we look for general patterns in the market, and we do that by starting with moving averages of length 50 and 200. So this is the 50-day moving average in yellow, 200-day moving average in green. We like it when they're both going up, and we like it when the 50 is on top of the 200. We have that here, and we like it even more when the 50 is separating from the 200. The shorter the moving average time span, the more sensitive it is to recent movements. So if you have an acceleration in price movement in a short period of time, you'll find that the 50 is going to pick that up faster than the 200 because the 200 has 150 more days of baggage to maintain than the 50 does, right? So whenever we've got a crossing of the 50 over the 200, like we did over here to the positive side, that's called a golden cross. On the other direction, it's called a death cross. We haven't had that for a while. And they are usually portents of what you think they might mean. They are lagging indicators, but they're generally portents of what you think they might mean. So here we start to get a little close with the leftovers of this pullback move, which is a multi 3-month down move into Halloween, a little spooky, but we recovered quite nicely. We had the AI run up in the summertime when everybody was pretty hyped up about ChatGPT and Bard and things like that. And then we had a bit of a cool off period from there, but we closed very strong into the year. Currently, we're just off of the 52-week all-time high of 48.02, 47.65 and 98 cents. So very, very close to that all-time high.
Wow.
There are some things that we need to be aware of here that I think are important for weighing the positive and the negative. The first thing that we do there is look at the Bollinger Bands. So the Bollinger Bands contain about 95% of the market movement. Not exactly 95. They're based on a normal distribution for the day's movements, and people who've studied the market for many, many years pretty much have a consensus that it's not really normally distributed. It has fatter tails than that. So this is an approximation, but it's a pretty good approximation, and it's good for trying to understand where are we in a cycle, or are we overbought, or are we oversold? So anytime we're on top of this line, like here, where we're on top of the blue line, that's overbought. And if we were below the bottom line, we would be oversold. The middle line is the 20-day moving average. So here's the 20-day moving average, the 50-day moving average, and the 200-day moving average. Right now, the price is above the 20, so just above. It's above the 50 and above the 200. We're not overbought. We came right up to the top of the Bollinger Band and bounced off. And you can see that this high is very, 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 very slightly higher than the previous high, which means we're still in an up move. We didn't get a lower high. We got a higher high. So all those things are positive. One thing that is potentially negative is typically when we see the Bollinger Band start to narrow, as we've seen here, a lot less volatility here than there is in this move over here. That's oftentimes a sign of reversal because the momentum is coming out of that move, right? And that's why the volatility is getting lower. And so that could be a harbinger of a pullback. How much of a pullback we wouldn't be able to say, but if you see something like that where you have a narrowing of the Bollinger Band, typically we think of that as a portent for potential pullback. Doesn't always happen. Sometimes you get something like this where it narrows and then you get a channel. And I can't really say that's a pullback. It's just that we didn't keep going up, right? So fair enough. We also look at things that are technical indicators of how the moving averages are converging or diverging themselves at different lengths, typically 12 and 26 days compared to a 9-day. And that's also good for looking at recent movements to see if we can find whether we've reached a top or a bottom. When the yellow line is accelerating to the upside of the white line, that's a positive. When the yellow line is accelerating to the downside of the white line, that's a negative. So we had a positive move here, and that was sustained all the way, I would say, until about here, which looks pretty good. But over here, we had a top out. You can see we crossed over right on New Year's Day, and we're still in a down. So technically, we're still with downward pressure, less momentum, even though we reached a very, very slightly higher high. From a stochastics perspective, this looks at where we are on a percentile basis in the last 10 days. We can see we're just below the 80th percentile. That's very high. And typically, we tend to oscillate from above the 80th percentile to below the 20th percentile. Doesn't always happen that way. As you can see, we had a reversal that was not going all the way down. We've had other ones where there's a reversal and retouch. But most of the time, you get a traversal. This one not. There's one, another one, another one, another one, another one, another one. Most of the time, you get that full traversal. So once we're on the, like I'd say, below 70, 65 here, we might be expecting it to pull back all the way to 20%. Anything can happen in the market, of course. Let's look at it from a longer term view before we look at some of the fundamentals I think that are important, and I'd be happy to take questions. Here we are from a 3-year view, weekly. And you can see now each of these bars is a whole week. All right, but MACD is positive here, and we're well above 80% on the stochastics. We're not overbought. We're still trending higher. The 50-week moving average is up. The 200-week moving average is up. So from a 3-year perspective, that's a very positive looking chart. Here we are from a 5-year perspective. I hope I said 3-year, 5-year perspective. Again, top of the Bollinger Bands, but inside 50 and 200 looking fine. MACD up, stochastics high. That's a pretty good trend for 5 years. This is COVID shutdown. This is trillions of dollars being spent. This is inflation. This is our recovery from inflation with AI hype. We lived through all that stuff, right? We remember it all. It wasn't that long ago. Here's 10 years. So this goes back well into the previous administration and even before that on a monthly basis. And you can see, again, we're at the top of the Bollinger Bands, which is not overbought. It's sustainable at the top. MACD higher, stochastics near the top. We've had a very good decade, COVID notwithstanding. And so we go back and we look here again at where we are with 1 year. And I want to remind you just a couple other things. So earnings are in process. We've got financials, tech, other sectors reporting. Right now, the P to E for the S&P 500 is about 25.5. The long-term P to E for that's price to earnings ratio. The long-term P to E for the S&P 500 post the internet is about 22. If you go back all time, it's about 18. But I would say since the internet, we have had a completely different economic situation of global connectivity that we did not have previous to that. And that has increased the price premium that people are willing to pay for $1 of earnings. So if you agree with me, then you'll go with 22 as the long-term average back to 1992. If you disagree with me, you'll go with 18. Whichever one you choose, we're at 25.5. So we're paying about a 20% premium, in my view, or maybe more if you have a more conservative view, to where we are now. So as earnings come in, we're going to have to make sure that the earnings are justifying these prices. Otherwise, we're going to be seeing people pulling back on what the prices are. The other thing to say is, of course, we have the Fed meeting scheduled for January 30th. I look at a couple of different things on that, but one is a betting site where people have what the prognosticated odds are for what the Fed is going to do. And right now, the odds are 96% no change and 4% of a 25 basis point reduction for January 31. I have never seen a time when the Fed has done anything other than what the 90+% say they're going to do. Could happen, but I think it's relatively certain they're going to leave it alone and say we're going to be vigilant and biases to the negative side on interest rates. I looked for the next one, which I believe is March. I don't remember the date. And that one has a 62% chance of a reduction in 25 basis points from where we are now. So that's what the betting public thinks. We'll have to see whether the betting public knows what it's talking about, but that is what the betting public thinks. And I would say, at least for the January 31 meeting, I agree they're probably going to leave things alone. So overall, a very strong last year. Inflation is subsiding. It's still above the Fed's target of 2 at the 3.8% range for CPI in the last one we got. PC, I don't remember what the last was, but probably in the same range. PCE is what the Feds rely on more than CPI. But PPI was very comforting. That's wholesale inflation. And so I think we're going to continue to see the Fed look to ease. And of course, we haven't really seen any oil spikes based upon Middle East things, still around 72 and change. So unless we see some other global event, I think we're steady as she goes at this point.
So
And
let me ask.
Voltaire, I think that covers what I would have to say. I'm happy to answer any questions. I see there's some chat, but I haven't been able to check the chat. So
Yeah, if anyone has any questions, feel free to type it into the chat. I have two questions for you. So,
okay.
uh, and by the way, guys, I I personally have a lot of money, and a lot of this stuff I don't understand 99% of it, and that's why we had Dr. Fogel on here so he could break it down for us. So two questions. One is I heard potentially right now the market, right? We're talking about the stock market here, is about 20% maybe overpriced. And so does that mean this year potentially people might, when earnings come out, they might say, well, you know what's overpriced? I'm going to sell some of my stock and cash out on some of my earnings. Is that like a possibility, a good possibility?
So it is certainly a possibility. And I think when we say 20% overpriced, I would say overpriced relative to the average P to
Mm,
E since 1992.
got it.
So we've gone through a lot of things since 1992.
Right.
All of the Clinton administration, all of the Bush administration, 9/11, the fiscal crisis, all that stuff, right? We went through all these things.
Okay.
The long-term average through all of that is 22. Right now, with inflation coming down and we've spent a lot of money and we probably still have some unspent money that needs to be spent or probably will be spent. It's not unreasonable to think that it would be a time when we would be above the average. And we've just had some presumably good breakthroughs in AI. I have my own opinions about them. We can talk about that another time if you like. But again, there's some reasons to think that we would be above the average at this point rather than below it. But should we be 20% above it? That would be the question, right? So it wasn't a surprise to me to see a pullback in the first week as people readjust their portfolios, having done whatever they needed to do to get their calendar tax year in order, all that kind of thing. Nice to see that we got back to the peak that we were at before. We didn't fail to get to that height. But if earnings do not follow through in the next 2 to 3 weeks as we get into February, then I think it wouldn't be too surprising to see a pullback. For me, I don't want to say, like definitely this, that, or the other, but a 5% to 10% pullback would not be surprising to me
Okay, cool.
in that case.
Yeah, and the next question I have is, um, where are like rich people going to put their money in this year? Like, what sector is it? Real estate? Is it the stock market? Is it the oil? Like, what do you see going to happen?
Well, I don't know what rich people do. I do have an idea what money managers do.
Okay.
So if I can answer it that way, I think um, we've seen over the last year a couple times when we had pullbacks where we had flight to safety, and the flight to safety was consumer staples and utilities and things like that briefly. But as soon as it was risk on, those guys did not do so well. And we saw things like travel, entertainment, and obviously technology, if you look at how the NASDAQ did, um, doing very, very well. So I think diversification being the key to money management, typically for clients, for risk diversification in terms of sectors. I think you're going to continue to see that, but I suspect as long as the leading tech stocks continue to show us earnings that deserve the price to earnings ratios they're getting, which are above 30, then you're going to see people stay with those risky investments, the high beta investments. I'm not sure, Voltaire, whether I'm allowed to even mention companies here, but I think if you look in the news, you know which companies are generally associated, like they say, like the FANG stocks and so forth, like that.
Mhm.
If you look at which ones have done very well in the tech side in the last year, as long as those guys continue to show that their earnings are justified, it'll be risk on as we get the next new tech advance.
Yeah.
Um,
and
Otherwise, flight to safety, you can think about toothpaste, toilet paper, stuff like that.
right. Yeah, and I like that coming from you, especially because your pops last time you mentioned him, I looked him up and I was like, man, this guy's a genius, with the
He
AI.
was.
So
He was, absolutely.
that's pretty cool.
There was a question I had in the chat here about mortgage bonds, and I must tell you, I don't follow mortgage-backed securities whatsoever. So I feel completely out of my league answering a question about mortgage-backed securities, and I
No,
hope someone else in this group tonight will be able to handle that question for
I
you
think so. I think so. Thank you.
in
What?
an expert way.
Thank you. And last question I think is the S&P 500, Nasdaq 100, bullish or bearish in the next 5 years.
Oh,
Oh,
5 years? Yeah,
yeah.
bullish,
Yeah. Okay. Cool. Yeah. He
bullish. Yeah,
he gave you a layup question on that
you
one.
did. How can
Cool.
I be bearish for 5 years? I mean, 5 days, I might be bearish, but yeah, 5 years is two cycles. So, you know,
Cool. Well, hey, I appreciate you jumping on. Thank you for your time tonight.
of
And
course.
yeah, it doesn't look like we have any other questions,
Okay,
but yeah, I'll take you up on that technology question later on at some other point in time in the future.
be happy to do that.
I appreciate you. Thank
All
you.
right. Thank you. There you go.
All right. So, cool. Awesome. I know there was a lot of information, but we need to have those type of discussions so it could at least start jogging our brain a little bit. Okay, next. We have Alfonso Delgadillo. He is a senior loan officer, about 20 years in the business, and one of the top producers in the country, which is really cool because he does a lot of loans. And whenever we have somebody on here that services a lot of people, they're gonna give us all their wisdom and all their experience over the 20 years of serving people and what's happened in the past and potentially what's gonna happen in the future. So Alfonso, welcome. I love your new headshot, by the way. Looks really good. So the floor is yours. If you'd like to share your screen, go ahead and share it, and then that we could check out, see what you got to show us.
Absolutely, brother. Thank you so much for the opportunity. As always, that headshot was way overdue, so people were already giving me a hard time. Like, hey man, like you tell us those realtors don't change pictures like often, and you have a lot of hair in your old pictures. I had to change my picture recently. No more hair. But no, thank you so much for having me on here. Definitely want to share with you guys what we saw last year in regard to mortgages, what we expected to see this year about mortgages. What we're doing right now, a couple of things that we're doing right now to help our consumers, our clients, our business partners, through the changing environment. So I am going to share my screen real quick and let's make sure you guys can see it. You guys can see the screen here?
Yeah, we can see it. Yep.
Cool. Like Voltaire said, my name is Alfonso Delgadillo. I run a team here in San Diego. I'm a local San Diegan, passionate for the real estate market, passionate for the mortgage industry for sure. It'll be 20 years in April. I just recently made a move to a company called Neighborhood Loans. I am honored to be the first branch in California. I'm going to open up the region. So I'm super excited, super pumped up because this company focuses on a self-centric company, which means helping our loan officers close more transactions and thereby helping our realtor partners with a bunch of different programs. But today I want to talk to you guys about, Voltaire and Voltaire's always picking my brain, like what the mortgage is doing, what's the market doing, what did it do last year? So, here's a graph, that I pulled up, and these numbers are coming validated and verified by Fannie Mae, Freddie Mac, Mortgage Association, and Wells Fargo. Okay, some big players when it comes down to the mortgage space. Okay, so as you guys can see, the different trends of the Fannie Mae, Mortgage Bank Associations, and Wells Fargo are pretty much in line. Okay, so if you guys can see here, it's first quarter of 2023, right? Last year, where the rates were, in the high fives, mid sixes, then towards middle and half of last year, we saw the rates spiked all the way up to like 7.5, almost 8% interest rates. That's when we saw everything coming really to a halt. That was probably like September, Voltaire, that we saw that slowdown, right? It was about September, October.
That's
We
about
really
right.
saw that slowdown. I mean, and for price points here in California or in San Diego specifically, when the rates go up a 0.5% or a full percent, it really buys into our affordability. So even though we had people willing or families willing to buy, with the rates creeping up so fast into those ranges, people were no longer qualifying for what they were qualifying, weeks before. So that's how it was. So we ended up the year with rates in the mid sevens, right? But towards the last of December, we saw the rates starting to come down. So the good news is for all of us this year, Fannie Mae, Mortgage Bank Association, and Wells Fargo are predicting that the rates by Q4 of this year, which we have an election, and historically, whenever we have a presidential election, rates do come down. And we also saw the Fed come out and say, hey, listen, you know what, we're not going to raise rates, right? And we expect to cut rates 4 times this year, 4 times. Now, December, we all went and shopped and bought a lot of stuff, right? And the GDP kind of creeped up a little bit, so they're a little bit concerned about that. But I have full faith that it wasn't that much of an increase of a GDP. However, I do see the rates will start to come down. And I talked, just like Voltaire, me and him are part of this high elite group of individuals in real estate and mortgage, and the people that we follow are saying that we're going to start seeing the Fed possibly cut rates in the Q1, the end of Q1. So we're projecting the rates to be in Q1 of 2024 to be, we're already seeing the rates at low sixes right now, right? We do have good programs that set the program for the call for, but we have a special program here at Neighborhood Loans where conventional financing, we're seeing rates under 6% already. Okay, but as we continue to the year, we're going to see the years, and we're probably going to close the year based by Wells Fargo and the Mortgage Bank Association in the mid fives, 5.5 to 5.875, which will be really good news for all of us, right? That is the reason why we're going to see a spike of up to 10 to 20% more sales in 2024 than there were in 2023. Okay, and
So you think there's going to be about 10 to 20% more home sales this year than last year?
Exactly. And
because the interest rate is going to drop.
Yeah. The problem is, like, Voltaire, we talk about all the time is, we need those rates to come down. I think the consumer is over the interest rates, that they're not going to be in the 2s and the 3s anymore. They actually want to buy a home. We really need the rates to come down, Voltaire, so that we get more sellers in the market, right? Like, people want to sell because they're outgrow their plays, they're too small, they're too big. However, when you're presenting to them, hey, you know what? You're going to go from a 3% to 6.5%, even though they're buying something smaller and rolling all their equity or something bigger, their mortgage is not where they want to be. So we really want the rates to come down so we can start to see more inventory. And as the rates come down, there'll be more inventory. And they're projecting that, this is the Realtor Association, they're projecting that there will be about minimum 10%, but they're hoping for 20% more sales in 2024 than there were in 2023. Okay. And we're going to see rates in the Q3 of 2025 hit below 5, possibly low 5s, even to the high 4s. I don't know that we'll go into the high 4s. However, all we really need for San Diego is rates to be like in the 5.25 to 5.5 interest rate range, and we're going to start seeing more inventory, and people are going to jump in the market. Okay. Cool. Perfect. So that's what we're seeing. That's what we're projecting for the interest rate. So here's what we're doing right now, Voltaire, and everybody listening. What we're currently helping families with the following options, right? They're saying there's 55% all the homeowners in America have on average 55% of equity. Okay, 55% of equities in home ownerships right now. So what we're doing a lot is we're seeing our people, our families, that did not make the adjustment of their lifestyles as the rates started to go up, and you know what? They got themselves into a lot of debt. So they're saying that 80%, 90% now of Americans have maxed out their credit cards, Voltaire. About 40% have defaulted 30 and 60 days on their credit cards right now. They're living beyond their means. So we're helping our families right now with a debt consolidation, using the equity that they built up, okay, to do a debt consolidation. And I know what you guys may be thinking. Well, I have a 3%. That would be crazy. Well, once we factor, Voltaire, all the blended rate, all the minimum payments that they're paying on credit cards, car loans, student loans, personal loans, all that stuff, and you compare it to a 2.5% interest rate, we're just helping families free up anywhere between $1,000 to $1,500 a month of output of cash between mortgage and minimum payments. So that's a big topic for 2024 for us in the mortgage space, that we're going to see a lot more families jumping in these opportunities, using the equity to do debt consolidation. How do we do that? We're also helping the families do a home equity lines of credit. Okay. A lot of families don't actually want to move out. I mean, you're an expert in the field, Voltaire. I mean, you're a total gangster when it comes down to real estate, owning doors and building out ADUs. A lot of these families want to use the equity to build home improvements or do an ADU, right? An accessory dwelling unit, so we can rent it out to their family, rent it out to someone else, or have their own family move into it. So we're also helping a lot of families. And here at Neighborhood Loans, we have a smart home equity line of credit. Within 20 minutes, they get approved, and within 8 days, they have the money in their bank accounts. So a lot of people are going to start taking advantage of the equity. Once again, we have on average across the country, 55% of equity in real estate right now, which is ultimate high. So use that equity to do some debt consolidation if you need to. Hopefully you don't, but if you need to, know that's option for there. Or leverage the equity, build a stronger real estate portfolio by doing home improvements, building an ADU, or buy some investment properties. As rates come down, it's gonna make more financial sense for you guys to actually buy more doors to build your real estate portfolio that will actually cash flow a little bit of money. So that's another reason why we want the rates to come down. Okay.
Cool. Let me just stop you there. So you just explain that a little bit further, because what happens, guys, is you buy your home, you stay in there for several years, and then you gain equity. The problem that we're facing right now is 65% of us have an interest rate of 4% or lower.
Mhm.
And we get stuck with the property because we can't take out the equity. So we have a problem. Okay, how do we use this equity that we have? Like Alfonso said, 55% equity in the property, hundreds of thousands of dollars in San Diego in equity. So the next step that typically somebody does is, like Alfonso mentioned, they start maxing out their credit cards because their lifestyle just kind of gets out of control. And they don't want to do a cash out refinance on their home because all of a sudden their interest rate is going to go from 3% to 6.5%. So what they start doing is they start taking out lines of credits, right? And I'm just setting this up for in a few minutes when we start talking about real estate. They start taking out lines of credit, and when they start taking out lines of credit, all of a sudden, their equity position goes lower because they're using that money. And then after time, this is what Alfonso's helping people with right now. Over time, then at that point, they reach out to someone like myself or Alfonso, and they go, look, it seems like I only have two options: either sell the property, get all my equity out, or people don't know they could do this, but with Alfonso's help, they could pull out equity on their property with a cash out refinancing. They take a 6.5% interest rate, which they didn't want to do, but then with that money, they pay off all their debt, their car payments, their credit card debt, their student debt, all these things that they're paying 10% interest, 15% interest, 30% interest. They're getting rid of that, and now their total monthly payment is a lot lower. So we're seeing that happen right now, guys. And what happens after that? People aren't good with money, right? So then people, what they do is after they go to Alfonso and they get his help, and a couple of years goes by, they start racking up more debt, and then that's when you start seeing these homes go for sale on the market, because then at that point they have to sell. So right now he's in the middle, Alfonso is, of helping people with that type of those type of programs. So the houses hitting the market, they're probably not going to start hitting the market as much as we're going to see until a couple of years when people start getting into even more debt, right? Because people just like taking on debt. But I know there's some questions for you, Alfonso. We have the question and answer.
Yeah.
What's the difference on purchase power from 5.5% to 6% interest rate? So if right now they're 6%, they drop to 5.5%, how much purchasing power ballpark?
Man, that you're taking about $70,000 to $90,000 in that 1% interest rate. So it's significantly like,
or 0.5%. Sorry, she's asking 0.5% from 6 to
5%. It's about 35 to 40 grand.
35 to 40 grand. Okay. So does that mean that if rates drop to 5.5% and they're currently at 6% ish, does that mean that prices to keep the same monthly payment, people are comfortable with the 6% payment? Now they could get for 5.5%. Does that mean that prices could easily go up another 30 to 40,000?
Exactly right. That's exactly right. And that's why, on here, I have another slide here, but it says experts are saying
Go ahead,
to
share
give
it.
back. Yeah. Let me show you guys this one. And this is, once again, I'm getting all this from good sources, right? But the experts are saying to get back in the market as soon as you can, because once rates come down, right, the competition is going to double. All right. So I was doing some stats, Voltaire. I actually found what you were asking me for earlier. And let me just read it off to you guys because it's pretty cool to know. So so we understand this is a lot of money, right? But in 2022, there was $2.75 trillion that was lent out in 2022 versus 2021, there was $4.5 trillion of lending. Okay. So it got cut almost in half in 2022. In 2023, right, it ended at $2.1 trillion over 2022, right? So that dropped nearly half. So if you guys compare over the last 24 months, half of the mortgage were originated in 2023 versus 2021. And that's because of the rate hikes, right? So why they're projecting sales to be up 20% this year is because the rates will hit the fives or the low sixes, right? Hopefully the high fives by the end of the year with the election year coming up. And they're saying that once that happens, sales will be up 20%. So if that happens, that means that we're going to end up the year with about $2.8 trillion of mortgages originated. Still nowhere near a 4.5 in 2021, but we know what happened then with COVID. Rates were artificially deflated. So the experts are saying, hey, if you're on the fence, get qualified now. And if you can actually buy something, buy now what you need, now what you want. Because the first-time home buyers or your first time around, you're not actually going to buy what you want. You're going to buy what you need. So if the rates come down, like Voltaire was asking me, the rates come down 0.5%. That's what happens. You go from qualifying for $600,000, which really is tough to get you a single family home in San Diego, but now you qualify to 640 or 650. So when that happens, the rates come down, the more competition you will have. So you have to be prepared for when that happens, you know? So I'm taking this from Fannie Mae, Freddie Mac, the Realtor Associations, and the Mortgage Banker Association. They're saying, hey, get back on the horse, get pre-approved, get qualified. You don't necessarily have to pull the trigger, right? Because we do consultations with no obligation, but get on there so you're ready for when the right property pops up. At least you're not losing any time, a week or two, trying to get qualified. Get back in there as soon as possible. And my thing has always been, it's never too early to start the process. So here's my contact info. If you guys want to, reach out to Voltaire, he'll put you guys in contact with me. Screenshot this slide here. I do free consultation, no obligation. We lay out your plan, but jump in there now so you're ready whenever you're ready to go.
Thank you. Thanks,
Yeah.
Alfonso. No further questions I don't see from anyone, so we'll move on. Thank you very much. Appreciate your time tonight. And let's go on to the next guest. We have Jesse Blanco, tax attorney. And he's been a tax and fraud examiner at Blanco Tax Law. Prior to becoming an attorney, he studied at USD. He graduated in 2006 after passing the bar exam and was admitted to practice. And he's a rising star. My favorite fact about Jesse is we're from the same hood. We grew up in Sherman Heights, man. And he has a really solid practice, has several employees and thousands of clients. So welcome, Jesse. Thanks for jumping on. I appreciate you.
Thanks for the invitation.
For sure.
So what I want to talk about, there's not much new laws coming in, but the IRS is auditing a little bit more than usual.
Okay.
So I want to talk about the topics that the IRS is focusing as far as like real estate professionals or people who are involved in real estate. And the main one right now that they're focusing on is people who flip houses. So
Okay.
normally what a flipper, they in their mind think I'm an investor who's investing and reselling the house. But the IRS considers flippers kind of like a dealer, or like if you're holding inventory. So they don't get taxed the same way if you were to hold a property for 2 years, rent it out, and then sell it. So normally, like what the IRS considers an investor is somebody who buys a property, holds the property for at least, a good 3 to 5 years as a rental property, and then eventually sells it. So that's considered an investor in the IRS. But the IRS considers flippers to be more kind of in a similar sense, like a car dealer. You're just buying, fixing them up, and selling them within 6 months. So
Cool.
the big mistake that a lot of flippers are doing is they're classifying themselves as investors, saying that they're holding the property for long term.
Yeah, for sure. So if you're a real estate flipper, you're not a real estate investor, you're a dealer. Make sure you address your tax situation accordingly, right? That way you don't get in trouble. Because they hired a lot of more people, right? To audit, the IRS did.
Right. So they hired more people. I still haven't seen that much of an increase. I've seen like maybe 5 to 10% increase from before, but not a significant amount of increase.
Cool.
Because what's happening with flippers, they're gonna get taxed at a higher rate than your normal real estate investor. So
Correct.
they're looking at about, because an investor doesn't have to pay self-employment tax, but a dealer will have to pay self-employment tax, which is about 15%.
Okay.
So if you flip a house and you make $100,000 profit, that's going to be an additional $15,000 tax you will have to pay on that flip.
Got it. So the more of the story there, I think, is just hold on to properties long term, guys. Save some money. All right. What else are you seeing out there where maybe people on here could make some money this year? And is there anything that you're seeing your rich clients do, your real estate investing clients?
I guess this has been out for a couple years. I mean, several years actually.
Yeah.
Is the cost segregation. That's right now, I think the biggest thing where a
Mhm.
lot of my clients are coming into me and asking me, hey, Jesse, I heard about this. I saw it on TikTok or Instagram. What is it? Can you explain it to me? The cost segregation. And it's been out there for, like I said, several years. And basically, it's just a way to accelerate your depreciation. So instead of having, depreciation on just your property, you're breaking it down to several pieces. So each piece, instead of being broken out to 27 years, you're breaking out to 5 years, 15 years. So what you're doing is just bringing up your acceleration more forward, but there'll be less depreciation in the later years.
Right. And by the way, guys, there's a question in the chat that asks, hey, Voltaire, is this going to affect your plan to flip properties this year? Because I told everybody that this year my plan was to flip a few properties. I'm not a flipper. I own a lot of properties, but I rather have more cash right now than to just be, cash poor, property rich. So I'm going to keep all my 51 rentals. But to answer that question in the chat, yes, as a flipper, I'm going to make more income, therefore I have to pay more taxes. However, I plan to use the cost segregation, what Jesse was just explaining, to offset a lot of that income. So everybody kind of gets an idea. What Jesse just mentioned, I've personally used over the last 2-3 years, where I have my business as a real estate agent, my income is high, right? Let's call it $500,000 a year. And the last couple of years, I haven't had to pay any taxes. The IRS actually sends me checks. Why? Because I own so much real estate and I use cost segregation, bonus depreciation to offset all that income. So, I file all my income. They see how much money I make, and then they see also that I own a lot of real estate. So then they go, oh, well, on paper, Voltaire's losing money, just like a lot of large landlords do. And then therefore, I don't have to pay taxes. And to answer that question again, I plan to flip properties, make more income this year, but I'm going to offset it by buying also some properties and just bonus depreciating and cost segregation. Is there any changes this year? There's going to be less that you could take on, Jesse?
I don't think you can take on, I mean, the bonus depreciation is dropping. So it's going to be dropping every year substantially. Right now, it's gone to 80%. Before it was 100%. You could just buy something and take 100% of it deduction. But now it's dropped to 80%. So it's
Yeah.
not too bad. I mean, there's ways to use the 179 depreciation along with bonus depreciation. So you can bump it up to like 90%,
Mhm.
but you're still not going to get that full 100% that you were able to get the previous year.
Cool. Perfect.
But the thing about cost
so-
segregation, the ones where I'm seeing that the IRS is rejecting the cost segregation is when they go onto these websites. It's kind of like a do-it-yourself cost segregation. Those the IRS is flatly rejecting them, and it's canceling the cost segregation. So if you are going to do a cost segregation, make sure you go through either somebody who's an engineer, architect, or a general contractor. But the general contractor has to be a contractor that actually builds houses. it can't be like a general contractor, like electrical or plumbing. He has to be somebody who actually builds houses, so he can give you the report that you need for the IRS.
Okay, that's good. So the tip there, and that's important, by the way, guys. If you do a cost segregation study on one of your rentals, okay, you can only do it on your rentals. Make sure you hire a legitimate company and pay them appropriately, because you don't want the IRS to come after you saying that it's, it's invalid or something, right?
It's kind of like when you do a real estate appraisal. You need to have the actual real estate appraisal. You can't just, hey, here's the Zoom price, you know.
Right.
I mean,
Yes.
the Zillow price, you know.
Little
Yeah,
price,
you
yeah.
actual appraisal.
Perfect. Cool. What others from the tax aspect should we know? Is there anything else uh that we should know to make money this year in 24?
I think what I tell most people, especially like real estate investors, there's two advantages of going from a Schedule C, which is sole proprietor, to, like, for example, an S corporation. And I tell them the main reason you might want to go from a sole proprietor to an S corporation is the IRS audits 90%. I would say 80% of the audits are focused on sole proprietors. Very little gets audited on corporations or S corporations. The majority of the focus is always on sole proprietors because they always find more mistakes with sole proprietors than they do with corporations. So that's the
Got
main
it.
advantage of switching over. And then once you hit a $50,000 profit, that's when you got to think about, let me move over to an S corporation to take advantage of all those tax savings that you can have, as opposed to if you were just a sole proprietor.
Okay, so the important thing, my takeaway from what you just mentioned, Jesse, is if you're looking to own real estate as a landlord, as an investor, make sure you have the right entity, right? And then that way you could maximize your tax savings. So that's someone, if you guys ever become investors and landlords, reach out to Jesse and then he could guide you in the right direction. That way you can maximize. Somebody's asking Jesse, there's two questions for you. Number one, have you worked in opportunity zones and tax exceptions for the opportunity zones?
And opportunities are really great to work with because you buy the property and let's say if it grows, let's say $200,000 or $300,000, all that capital gain can be waived or not taxed. So that's a great thing about opportunity zones. I know there's some in actually National City, a few zones, and
They're
so it's
all
great
over.
to buy those properties.
Yeah, they're all over city, San Diego and National City, and so should he reach out to you about that? Do you have experience with that?
Yeah,
Okay,
definitely.
perfect,
Yeah.
perfect. Now, do you have someone for cost segregation you could recommend?
I have two people that I
Okay,
usually recommend for cost
perfect.
segregation.
So maybe,
And
well, we'll drop Jesse's information and then Jesse could, you could email Jesse asking, and then from there, Jesse could recommend those people, right? Is that cool?
cool. Like I said, they'll do the actual construction analysis, and then I'll do the depreciation aspect of it because I'm not an engineer or a general contractor, so I can't do that part of the study, but I can
Yeah.
do the depreciation part.
All right, perfect. And then how do taxes come into play when selling a property and rolling the money over into a new property? So if you want to just break down quickly the two scenarios, one for investor and one for a primary residence owner.
So if it's your primary residence, you can't do what's called a 1031 exchange, which I think is what the person's asking about.
Correct.
So if you're gonna sell it and you're gonna say, I'm gonna buy another property, well, there's no 1031 exchange where you can just roll it over. But if it is your primary residence, you get an exclusion of 250,000 of the gain. So if you're married, it's actually 500. So the first 250 per person will be tax-free of the gain if it's your primary residence. But if it's an investor, then you can do a 1031 exchange, roll over the whole amount into the new property, and there'll be no tax until you sell that other property.
Perfect. Thank you for answering that. And then the last question we have in the chat, Jesse, is if someone decides to go from a sole prop to a S corp this month, will that affect us during this tax season or the next tax season?
So it becomes effective. Let's say you submit the paperwork, let's say tomorrow or the end of the month. So the month of January, you'll be a sole proprietor, but February all the way through December, you'll be considered an S corp.
And then they would deal with it next year.
Yes, when you do your tax return next year,
Yeah.
you'll have both the sole proprietor for January and then the rest of the year S corp.
Okay,
But the money has to be going through your S corp.
perfect. And then the last question is, if you had $1 million, where would you put it this year?
Real estate.
Real estate. Cool.
Yeah.
I like that answer.
It's to me, it's the safest and most, I don't know, it's just like the best. When I see all my clients, and I try to see what my clients are doing, and I try I'm like, oh, that's a really good idea. Let me try to follow that. The majority of them that do really well are in real estate, or the
And-
majority of their portfolio is in real estate.
And how many clients do you have? Ballpark?
I think total, I'll say about 4,000.
4,000 clients. And ballpark, what's the richest one? How much net worth?
Net worth. I think he's about worth 28 million. Yeah.
Cool.
But that's how much he has in his bank account,
Oh, that's
or
not
like
even
his
net worth.
like stocks.
That's
I'm not
liquid.
even talking about his real estate portfolio.
That's
That's
just liquid. Yeah.
liquid. Yeah.
That's awesome. Cool. Awesome. Well, we all want to be there one day. Appreciate you jumping on, sharing that with us, and we're gonna type in your information that if anyone wants to reach out to you, they have your info and they could ask you any questions. So Eleazar, if you could do that, that'd be awesome. By the way, I have a couple of co-hosts today. I have Eleazar Cruz. He's there somewhere in the dark. I don't know. I don't see him. And then I see Raul Santamaria on there. What's up, Raul? Thank you. And I don't know if we have any other co-hosts with us. I see my sister, I see my mom. I don't know if they're helping or just learning. All right. Well, I appreciate you guys. Who's next, Eleazar?
You are.
I'm next. All right, let's do this. You want to share for me? I'm excited. I go up early this time. Usually, I'm at the end. All right. Cool. Hey, let's get right into it. Hey, the entire purpose of this, guys, is we want to know what's going to happen in 2024 with real estate. We want to know where to put our money. So this is just the housing inventory. 2024, right now, we have 2,052 homes for sale. Last January, 12 months ago, we had almost 2,900 homes for sale. What does that mean? The supply of homes is very, very low right now. If you see on the right-hand side, normal is 7,000 homes for sale. We're only at 2,052 homes, so we're way undersupplied. And then on the bottom right, you see 2008, the year 2008, which had an inventory of 16,000 homes. So there's a lot of people that say, hey, I want to wait till prices go down. The market's going to crash. Guys, you see how many homes we need in order for the market to crash. 16,000 homes. Ballpark. We need easily over 10,000 homes for sale on the market. So we need 10,000 for sale signs. When you're driving down the street, I don't know if anybody was around in 2008. I remember just driving down the street, you see for sale sign, for sale sign, for sale sign, for sale sign. There's 16,000 homes for sale. And by the way, half of those homes, 8,000, were in foreclosure. Guys, you see how much homes we have right now? Only 2,052. So that tells you a lot. Let's go on to the next slide, please. Buyer demand. Buyer demand is up 37% compared to last year. So more buyers are jumping into the market today than they were 12 months ago. I'm assuming because the interest rates are dropping and buyers just don't want to rent. Let's go on to the next slide, please. Market time. It takes 30 days to sell a home today compared to 24 days a year ago. So nothing's really changed there. The only thing to really note on this slide is anything under 90 days, guys, is a seller's market. What does that mean? Sellers have an advantage anytime homes are selling for under 90 days. Right now it's 30 days, so they're selling fast. So it's not a time for, let's say it's not called the buyer's market where buyers have like a lot of leverage right now. Let's go on to the next slide, please. Prices. This is a big one. Now it's $837,000 as of today. Median price home in San Diego, $837,000. 12 months ago, $764,000. So it increased 9.55%. Let me repeat that again. Over the last 12 months, home prices have increased almost 10% from 764 to 837. So whoever owns real estate, you're doing awesome. Whoever owns multiple pieces of real estate, like myself, you could just see just from this slide that my real estate went up a lot and I made a lot of money. On the right side, 2006 to 2007, the median price home was about $500,000 that year. So you could see that, over the last 20 years or so, or 15 years, it definitely went up from the $500,000. Let's go on to the next one. I want to share something. I just came back from Mexico City, and I was there for some time. In 2021, I went to Mexico City. In 2021, I went to exchange my $1,000. I usually take $1,000 cash, and they gave me 20,000 Mexican pesos, and that gets me through the time. And I pay credit card for the rest or whatever. Fast forward 2 years to 2023, guys, that same trip, the exchange rate was 16 pesos per dollar. So for $1,000 I only got 16,000 pesos, which wasn't enough. So what did I need? I needed 20,000 pesos. So instead of my usual, $1,000 for my trip, it was $1,250, aka 25% more just for the same trip. So I have to ask myself two questions. The first question is, did the Mexican peso get stronger? Or did the US dollar get weaker? Question number two, we have to ask ourselves in regards to real estate, did home prices get stronger? Or do you just need more US dollars for that same home? So this is something that we really have to philosophize. And when we talk about inflation, we all know we go to a grocery store, we're paying way more money for groceries than we did 2 years ago in 2021. So we have to ask ourselves, well, are groceries just more expensive, or did the US dollar get weaker and we need more US dollars to buy that same piece of grocery? Just like my Mexico trip. And that's what I want everybody to think about. And Eleazar, if you could go back to the price slide. Backwards. Yeah. So you see 12 months ago, you could buy the same home for 764 that you could buy today for 837. So you have to ask yourself the question is like, the home prices really go up, or is the US dollar just that much weaker that you need more US dollars to buy the same home? I think that's a good question for us to ask ourselves. That way you're not scared of buying a home or getting into real estate or investing into real estate because prices are so high. No, it's your US dollars just getting deflated. So exchange your US dollars for a mortgage, right? Let's go on to the next one. Interest rates. Alfonso touched on this. Today they're about 6%, and they were at 8% a few months ago. Sorry, that should say 2023, right? October and November 2023. And the average interest rate over the last 50 years is almost 7%. So, we're on average over the last 50 years. And last year, when we started at 6% to start the year, that was the highest since 2008. So interest rates were low for many, many years. All right, let's go on to the next one, please. This is pretty cool. This is the number of mortgages by interest rates. So on the bottom right-hand side, let's look at the yellow box. It says 25% of all households have a 3% rate or lower. 65% of all households have a 4% interest rate or lower. And 42% of households have no mortgages at all. So imagine that, 40% of all the households don't have a mortgage, 42%. That's 4 out of 10 people. They're mortgage free. And then 65% have a very low interest rate. So that's what's happening with properties right now. People don't want to get rid of those low interest mortgage. Let's go on to the next one, please. So this is a cycle, right? So basically what it's showing is the only way we could really get into a housing depression where prices just drop is we need that hyper supply. Phase 3. So you see phase 1 recovery, phase 2 expansion, phase 3 hyper supply of real estate. We're not getting that. So if we don't get there, we're not going to hit phase 4, which is a recession when it comes to real estate prices. Let's go on to the next one. This is something similar. This is a real estate cycle. So we need that oversupply, which we're not even close to right here in the orange. We need to be there in order for us to experience a real estate recession. It's just not happening. And then if you can see distressed properties, a year ago, there's 19 people in foreclosure in San Diego that couldn't afford the mortgage. This year, there's 22 properties in foreclosure in San Diego. That's not a lot of people. I just showed you guys a slide where there's in 2008, there's 16,000 homes for sale, and half of those 8,000 homes were in foreclosure. This isn't even close to that. Let's go on to the next one, please. This is more of the same, just talking about 48% of homes have at least 50% equity or more. And then 90% of homeowners have 20% positive equity, 20% equity or more in their home. Just like Alfonso was mentioning earlier. Let's go on to the next one. Rent prices. If you could see on the left-hand side, it says rental occupancy rates are between 95 to 98%. So there isn't a lot of vacant homes. Rents, actually, I meant to take that out. Rents are not jumping. They're holding steady right now, and they're getting impacted just as slightly. And as always, it may be risky to purchase investment properties based on Airbnb income. That's not what I do. That's not what I preach. But on the right-hand side, let's look at the average rent in San Diego. It looks like this price takes into consideration all bedroom counts, every type of home in San Diego, and it's up 4% from last year. So rents are up 4% from last year, and you could see that the average in San Diego is about $2,800 ballpark. Let's go on to the next one, please. And this one shows the one bedroom. If we look at the medium price one bedroom rent, San Diego in 2022 was at 2,500, and then 2023, San Diego was at 2,400. So we saw the one bedrooms go down. So that means that the 2 and 3 and 4 bedroom homes went up in value, while the one bedrooms went down $100 over a year period. All right, let's go on to the next one, please. Construction. There's just not enough built. We need about 16,000 new homes being built every year in order for us to keep up with demand, because there's a lot of demand. We're not even close to that. Right now, we're negative supply. And depending on which article you read, we're negative 35,000 housing units to 125,000 housing units in San Diego. So they're not building enough homes still. Let's go on to the next one, please. And overview for the opportunities this year is, number one, let's borrow money now. The bank will let you borrow $800,000 today to buy a home, and they'll give you 30 years to pay it back. I don't know about anybody on this call, but if you tell me right now, hey, Voltaire, I'll let you borrow money and you have 30 years to pay me back, I'll borrow that money from you right now. I won't even, with my eyes closed, I'll borrow it from you. That's the best deal ever. Like, who's ever going to offer you that? Number two, ADUs. You can still convert your garage and put an ADU in your backyard. There's very a lot of favorable laws for you guys to do that and take advantage. There's going to be an architect on here that's going to explain more of that in a bit. And then number three, having someone pay off your debt over time, aka rentals. That's a huge opportunity still. However, it's not as good as it was, but I think that there's going to be some opportunity later this year for that. Number four, San Diego market. I think that prices will stay strong. I don't know if we ended up getting there was an Instagram video. Is there an Instagram video somewhere on there, Eleazar?
No, there isn't.
There isn't. Well, there isn't. Guys, San Diego, okay, that's number four, has the best weather in the country, hands down. And a lot of us don't realize that, but people from other places realize that. The Instagram video was like the ocean in Chicago was just frozen over. if we think it's cold right now in San Diego, I mean, it's nothing compared to the rest of the country. And I've traveled the rest of the country, and it's not as nice, the weather. So I think San Diego overall, over the next, you know, future, many, many years, people are always going to want to live here. And that's why, and then we're not building enough. So it's going to be a strong, you know, real estate market for years to come. And then the fifth opportunity is subject to properties where you could buy a property and without taking on a mortgage on your own, you take on the existing mortgage on the property. So um, that's my part of it. Does anybody have any questions? You could throw it in the chat, raise your hand. We'll unmute you. All right. If no questions on the real estate portion of it, then we could go ahead and was this recorded? Yes, we're recording this and it's going to be somewhere online, probably YouTube. Juan says, I lived in Chicago during my childhood. Everyone was super jealous when I said I'm from San Diego, especially during the blizzards. Yeah, it's like the rest of the country sucks, really, when it comes to all that. And San Diego, we're blessed. We don't even know. I didn't know how blessed we were until I started traveling. All right.
Voltaire, quick question.
Yes.
What part of the that slide with the different colors? What part are we in?
Good question. Go back, Eleazar. The slide with the different colors, please. Okay.
Right there.
I mean, look, we recovered from the financial crisis in 2008, right? So we recovered, I think, through like 2016 or something like that. And that was like the recovery stages. And or sorry, the recession was, I think, 2008 to like let's call it 2016. And then from 2016 to 2019, we started recovering, and then COVID happened, and then we started recovering from that relatively fast, and we started to expansion. But right now we're like, I think, in the beginning stages of expansion, like the very light green, number one, yeah, right there, because we're not building fast enough. And finally, developers are starting to take advantage in San Diego and starting to apply for to build units, but they're not building residential houses. They're building condos, not even condos, but they're building apartments for people to rent. So I think if you own real estate, if you're the owner of the real estate, you're not renting, it's gonna be a great ride up during this expansion that we're gonna experience. But you have to own it. You cannot rent the real estate that you live in order to be part of that. And the reason why I made over 7 figures in the last 12 months wasn't because I'm a genius. It's just because inflation helped me out. I own assets like real estate that do very well during this time where the dollar gets devalued, because now you need more dollars to buy the same piece of real estate. So good question. Thank you so much for asking that. And I think no more questions, so we could go on to the next person. And by the way, guys, I'll just remind you guys, if the whole point of this tonight is so we could make some really good decisions about money, and we could grow our wealth in 2024, and not just for ourselves, but we could help others with our wealth, and we could help our communities, and everyone's happy when that happens. All right. The next guest, Abelardo Lopez. He is a designer and architect from Mexico, and he also has a master's degree in real estate development from Woodbury University. And he focuses on development projects as an investment. So he helps a lot of really rich people develop real estate. Abe, what's up?
Hey, thank you so much for that beautiful introduction.
Yeah, of course. I just want to know who's the artist who took that awesome photo of you.
I think it was my son, actually.
All right.
So yeah, so talking about construction and permit processing, it's been super busy. Everybody is eager to develop or do something with their projects. I'm gonna start sharing my screen.
Do.
Okay. Just give me a second. So, first of all, I've been super busy, and all my friends that are architects and designers are also super busy. It's really hard to find the right people to work with. There's not enough drafters and designers to hire. It's really struggling for that side. And one of the things that we're seeing is a lot of people are going for ADUs like crazy, especially family that wants to create another unit for their kids or for rental income. And sometimes it's faster to buy 5 single family homes and do ADUs and do in a multifamily apartment building. And it's easier for a small investor. So this chart that we see here is the interest rate. And this chart is showing basically how the other markets react. So this is a lumber. So can you see like basically when the interest rates went up, the lumber went down. Right now, what we are seeing is the materials on construction are stabilizing. They're not fluctuating as much as they used to. And we will see a little bit of stabilize and a little bit of a going up a little bit with inflation in the next future. That's the projection of next year. This is steel. So steel is a little bit lower. Why? Because the gas prices are really low. This is what is going on in the Middle East. The price of steel rebar is going to be cheap, but the prices for more mechanical and electrical components are going to be expensive. Demand for windows and all that stuff, it's really behind for the demand. So if you want to have a custom window, you have to wait about 6 months. So that takes a toll. So this is a projection for construction. So from the permit point of view, for the construction point of view, just to finalize this subject, we think that the price for construction is going to stabilize and prices for residential are going to get a little bit lower. For multifamily and for bigger developments are going to be expensive because hiring people that are experts on their field is harder, and like electricians, plumbers for big projects are really busy. But we're going to see, I think, for smaller projects, a lot more flexibility in the future. That's what I'm thinking is going to happen, because a lot of the people for the middle sector, like 6 units, 8 unit, 10 units, are holding down because their numbers are not penciling out for the interest rate and the construction cost. And we still have a lot of money from COVID for big projects. So
by the way, you said you think there's going to be opportunity for small developers to build, and we're going to see a lot more smaller developments and bigger developments. What do you consider small?
Like ADUs, like a fourplex, like something like that size.
Okay, so one ADU, 2 ADUs, up to 4 ADUs, small. Okay,
Yeah.
cool. Perfect.
Yeah. So what I've seen, especially for other architects, is they're either doing a lot of ADUs or more than 30 units and up. Every time they're doing like 15 units to 30 units, it's really hard to make a good profit unless you have a really competitive construction cost or a good loan. So that's been the trickiest part. And I've seen a lot of projects that have been put on the market when they're like between 18 units to 30 units, and a lot of other projects they're are trying to use other densities to make more units just to dilute the investment.
Okay, got it.
Okay, so for loss, right now, well, in 2023, we have the SB9. Basically, that allows you to split a lot in half and make 2 units and 2 ADUs, or have a fourplex, like a duplex plus 2 ADUs. This only urbanized zone. This has been since 2023. They have been a few changes in the last year, and this law. ADU, we got the bonus density in San Diego.
So real quick, if you live in San Diego and you have a house with a lot, you can split your lot in half and then you
Yes.
sell it to somebody else, and then you can build units on the other one and on yours.
Yes, but you
Okay.
can only do 4 units on the whole property. Like if you split it in
Oh,
two,
yeah.
you can only do 2 on one side and 2 on the other.
So if anybody needs some extra money, split your lot in half and then sell it to Abe, and then he
Yeah.
could with his friend.
So there's a few, things that you need to comply.
Of
Like
course,
first,
we won't
yeah.
go over those. They
Okay.
could call you and ask you, but I'm just planting the seeds for everybody out there of
Yeah.
opportunity. If you have a lot and you have a house, you could split it, sell it to somebody else, and then you can live happily ever after in your side.
Yeah.
Cool.
Okay. Yeah. Now on San Diego City, we have the ADU bonus density. So that's a new one. Like the state of California allows you to do 2 ADUs, one attached to your house and one detached from your house. And San Diego, the city of San Diego gives you as many ADUs as possible. If you do one affordable ADU, they give you another one. So they give you the 2 by right by the state, and then you can fill the rest of the property with more ADUs until you cap the FAR. That's a floor area ratio. Okay.
Okay.
So if they also increase the multifamily FAR, the floor area ratio. So if you do like in a multifamily zone, if you just do less than 3 units, they give you 1%, like a number of FAR. But if you go over 3, they give you a bigger FAR, and then if you go more than 7, a bigger FAR, and more than 8, a bigger FAR. So this allows you to have more buildable square feet, so you can fit more units in the same lot.
So let me ask you a question. Why is the city and the county and the California, why are they giving us these laws to build more?
Because we don't have enough housing for everybody, and the rents are really high, and it's really expensive to live in San Diego, and it's really expensive to live in California. And the only way they can make this place affordable to everybody is to have more houses. So the bigger the demand, the more expensive the projects are.
Got it. Okay. Now we know.
Okay.
What else?
So we also have complete communities. Basically, we have zones in San Diego, and that allows you to increase your FAR like 6 times more compared to multifamily FAR. That's a lot more. Those laws have been there for a long period of time. The new laws that we've seen this year is, one, you are going to be able to sell your ADU. So that's the new one. The problem is we don't know what the requirements are going to be for each city. We don't know if you're going to need to create a condominium. We don't know if the utilities have to be separated. We don't know how it's going to start. We haven't done one of them. Nobody has requested one yet, and we don't know the process. Each different city and municipal code is going to change, so we will adapt so each city. Now, San Diego is also put on the news that they're going to expedite the complete communities process for 30 days. That's not feasible. The same thing they say for ADUs. They say that in 60 days, you have to have an ADU approved, but that's not the reality. I think that's only for the news, especially a complete communities project. They're really complex. They have a lot of information, and there's no way, they will pass all the reviews at once and in 30 days. I think it's just an advertising. So there's also a new law that's called the SV10. It's been on the project for a long period of time. They pre-approved a section of it in October. They didn't approve all of it. I don't want to go through it. They're just basically giving you more incentives to have less parking, to have or zero parking at all, more units, more density. It's mixed with ADUs. It's mixed with complete communities. It's a long process. I'm gonna paste that on the comments so you can take a look in that video. So let me just get to the final one. Permit time. That's a question that I always get all the time. Let me see if I can make this bigger. So in 2022, when COVID hit, the last year of COVID, a lot of people retired from the cities. The reviewers, especially structural engineers, they were old and they didn't want to work online. And that took a toll last year. So all the structural
old? What do you consider old? Just so you could
old people that was working on the city for more than 20 years. I'm not going to say the age.
All right,
The people that senior reviewers. Let's put it senior reviewers. So a lot of them just got tired and retired. And they hire new people, but they were behind around 3 months the last year for every single review, special structural reviews and really complex reviews like big projects. They're really, really, really behind. Last year, an ADU was taking around 5+ months, sometimes 8 months, and a multifamily project was taking a year and a half to get permit. This year looks a little bit better. I think the reviews are being faster. I've seen in the last month and the last end of the year and the beginning of this year, the response from the city are being faster. The biggest hiccup is just getting the final permits at the end. Like, I don't know what's going on, but when they tell you everything's authorized, we need to pull the permit, they take like 4 weeks to give you the final permit. They tell you everything's approved, but they take 4 weeks just to give you the permit. Structural is still a little bit behind, not 3 months, but less. A big change is San Diego County has removed all the incentives for ADUs. So to permit an ADU in the county is like 3 times more expensive than last year.
Wow, that's crazy.
Yes. Chula Vista is the slowest city to permit a multifamily project. They're really, really way behind. They hire a new company to review their projects. And that's the other one. A lot of cities have hired new companies to review their projects. One of them is True North. And sometimes they make things harder because they just give you like a huge list of comments to address. And sometimes the comments are on the plans, but they just don't review it thoroughly. And it takes time to know those people and get projects done.
Okay.
So basically that's it. There's a lot of people requesting new fee proposals to do ADUs, to new remodels. I've seen a lot of people getting HELOCs just to do an ADU or to do a remodels, and things looks really nice, really good for us.
Cool. Awesome. Thank you. Hey, we have some questions for you. Number one, are solar panels required on new ADUs?
Yes, they are. Yes,
Okay.
you can defer the permit until the end of the construction. You can also defer, like get a company and they can install the panels like 6 or 8 months after you finish the project, but you need to show that you have a permit for a solar panel.
Thanks for letting me know right here in front of everybody what I need to do, because you didn't tell me that last time we had a conversation. But
I
hey,
did.
no, you didn't. Anyways,
We have a recorded of that meeting. Let's take a look.
Next one. Do you recommend getting a property with an ADU already built in, or should you do one from scratch?
Okay, I do not recommend buying a property from scratch, like an empty lot. Is better. Yeah.
Okay. Sorry, go ahead.
So yeah, if you buy an empty lot, it's really, really expensive to get anything done. Normally, just to get the utilities there is expensive. It's like $100,000. It's better to buy a property that had a house or has a house. And if you have a house, you can always have more income in the same house. So it's just a matter of numbers and location. I think the location is one of the most important keys here.
Oh, yeah, and I would say just buy some if you could buy something already without it, it's easier.
Yes.
How much is the price of construction right now?
I've seen prices dropped. Last year we were looking at 350 and plus, and I think prices going around 300. I've seen guys that building with 250. To be honest, I don't know how they do it, but that's low for us.
They use unlicensed workers that don't speak English. So what Abe means is $250 a square foot, $300 a square foot, and it used to be $350 a square foot. So now you could get it for less, which is great news. I'm happy to hear that myself. I'm building ADUs. I'm waiting for some permits on some new ones. I'm working with Abe right now, guys. So it's very important who you end up voting for. I mean, I didn't know how important voting was until I'm in this process. I'm like, why is it taking so long? You know, we need somebody in each city Chula Vista, Carlsbad, San Diego, whatever, you know, to go in there and say, hey, we want more housing. We're going to make it easier on homeowners to develop ADUs and on developers to develop projects. So it really does matter. I never really cared for politics, but we need people who are pro building. All right, cool. Thank you, Abe. I appreciate your time.
Problem anytime.
All right. We're always learning with you, Abe, especially me right now with the solar panels. It's going to cost me some money. All right. AJ. All right. So we have Mr. Gupta, Attorney Gupta, recognized as a super lawyer between 2015 and 2018. I want to know what happened between 2019 and now. I hope that's an old stat, which is reserved for the top 5% of the lawyers in the county. And then also, he's one of 14 certified bankruptcy specialists in San Diego and widely regarded as an authority in the area of real estate and corporate law. So I appreciate you jumping on. Attorney Gupta, what's up? Welcome.
Hey, Bolt, can you guys hear me okay?
I can hear you. You see your professional shot. Is that
Yeah, that's pretty much what you're going to get today. I apologize. I was in a spot that I thought I'd be able to do this. I'm taking this from the car, which is not the greatest as far as things go. I can put my camera on, but
Hey,
you know.
now I know what happened between the years 2019 and 2024.
No, yeah, I think it's just old, is all it is. I'm not sure what it is, to be honest with you. But I know I'm still a super lawyer. That's all I care about. But yeah, no, it's all good. So I do have a PowerPoint. If you let me share my screen, I can do that.
Got you. We got you. Eleazar, he's behind the key.
Cool. So I'm gonna go ahead and share my screen and start from the beginning. Can you guys see my screen all right?
Yeah, perfect.
Awesome. And let me blow this up a smidge.
And you can do that all that on your phone. That's crazy. Okay, well, I know you
No,
don't
I
have.
have both. I have both. So I have both.
Okay.
So
Gotcha.
so this is my. See, I know what I'm doing here, Bolt. So anyway, I just want to talk a little bit about what. So I'm a litigation attorney. I have a subspecialty in bankruptcy. So that's kind of what people know me about is like real estate litigation, foreclosures, bankruptcy. Kind of if your project turns into a mess, then usually my phone's gonna ring for some reason or another. So that's why I think everyone kind of asked me, hey,
John, we're gonna mute you real quick. Sorry about that, AJ. That is our
no worries.
Yeah.
No worries. So that's what we're going to talk a little bit about today. Is we're going to talk a little bit about bankruptcies and foreclosures and what it means as far as where the market is. But the first thing I always tell people is like, bankruptcies are a lagging indicator, right? People go out, they get into trouble, they borrow money, they borrow more money, they liquidate their 401ks, they get the equity in their house out, and then they file for bankruptcy. So it's what we call a lagging indicator. And so that's the first thing that you need to really understand about what bankruptcy is. So what can bankruptcies tell us about the market? I always say it's nothing. It's always a lagging indicator. But where it is very, very useful is it helps us try and understand how bad things are and what caused it. So I always start out these things talking a little bit about again, I'm going to try and blow this thing up again. Let me see if this will work. Does this work? Maybe this one will work. There we go. All right. So that's slightly larger here. I know this is a lot of data, but like I think data is like super, super important. And these are actually the bankruptcy numbers across the last really since 2000. And we're going to drill down on these a lot. But the most relevant stuff to most of the people on this call is the recent data there. And if you kind of just jump over to this 2021, 2023 area here, you can kind of see exactly what I'm talking about. And what you can see is, since COVID hit, prior to COVID, you saw baseline numbers around 8,000, right? 8,000, 7 to 8,000 bankruptcies. And these are the numbers for San Diego County. And prior to that, you even saw higher numbers as closer to 2016, 2012 was a really high number. Of course, if you go over here to the right, we know what happened between 2006 and 2011 was the foreclosure crisis, and that drove a lot of the bankruptcy numbers. So what we do find is, and now here comes the trick, go. All right, cool. So we're going to spend a little bit of time looking at this. And I apologize because I spent forever trying to figure out how to turn this into a nice, pretty chart, and I couldn't do it. So, you know, shame on me. I'm not very good at this. I'm bad. You're good. All of that stuff. So, but what you do find, and we're going to spend a little bit of time looking at a couple of these areas, and I'm just going to fast forward to this one here because this is, I think, more interesting, at least to me. And I broke this up a little bit, and it's important to look back across history a little bit because we know that the foreclosure, the last time we saw a major foreclosure crisis was really '07. And you can see it here. If we were to look at this data here, the highlighted section in particular, right? You see 22,000 NODs issued in 2007. And this is, again, San Diego County data,
And then
leading to 8,400 foreclosures. And these are deeds, these are trustees' deeds that were recorded with the county recorder's office. So you see that the foreclosure crisis starts here really effectively in '07. The first data point that you want to look at here is the delta between '05 and '06. And what you see here is a significant drop in bankruptcies. And it's really important to understand why that happened. So '05, there was a law that was passed that made it more difficult to file for bankruptcies. And so what you saw was, you know, with interest rates, you know, hovering around 6 to 7%, the average number of bankruptcies that are filed in San Diego County are 11 to 12,000 bankruptcies a month. You jump here to the '05 law that's going to make it more difficult to file for bankruptcies, and then it jumps to 1,500, and then you see it kind of drop down significantly, right? And then what happens after that is we hit the foreclosure crisis, and that's in here, in this range here. And so the foreclosure crisis happens, and we see foreclosures. The NODs are going through the roof in '09, 2010, and really, and again, what we see here is the bankruptcies don't peak until about 2 to 3 years after the foreclosure crisis hits. You're at 23,000 bankruptcies in 2010. And again, this is that lagging indicator. It's usually about 2 to 3 years behind the market, you know, and so you see that pretty consistently across the board is, so let's keep pushing through this. So as you continue down through, and of course, you know, we get to historically low interest rates after that. That's how they fix the foreclosure crisis, is they say, look, we're going to print money. We're going to make money very easily accessible to folks. And as a result, what we see from pretty much '07 all the way until really, I mean, very, very recently, as interest rates continue to go down and down and down up through the pandemic in 2020. And the net effect, once the foreclosure crisis is over, right, and really it starts to abate in 2012, and you start to see the BKs going down, you start to see the NODs going down, and really from like 15, 16 through 20 through the once the pandemic hits, because I think the pandemic's a completely different animal, and that changes the game significantly. You start to see bankruptcies baseline at around 77, around 8,000. You can see this area from 16 to 19, from 15 to 19. They start to baseline around 8,000 a year. You start to see the average foreclosures. You know, you start to see an average of around 3,000 foreclosures a year annually. And again, you start to see these numbers, that the actual deeds are actually decreasing consistently as interest rates continue to fall. But again, things start to level out and start to baseline against interest rates. And the interesting thing about looking at this from that lens is you start to see patterns emerge. And, you know, back in the day when we were talking about 6% interest rates, you saw BKs around 11,000, NODs around, you know, 5 to 6,000. And now you're seeing it with interest rates lower. The BKs are down to about 2/3 of where it was historically, and the same thing you see with the NODs is the defaults are down proportionally about 2/3, and that's interesting because now we see 2020, 20 and 22, 2020 and 2021 and into the first half of 2022, interest rates get to historical lows. There are almost no bankruptcies being filed in that time period. There's almost no foreclosures in that time period. And part of this is because of the moratorium that was in place. But you can see that there's almost no activity in foreclosures, and there's almost no activity in deeds of trust. So, like, we look at that, and I look at that as being directly proportional to interest rates. And we see it both in the litigation side, and we see it both in the bankruptcy side. And I'll give you the example that I talk about frequently, especially with real estate investors like yourselves. You know, the average project that goes bad in my world looks a little something like this. You have a person that has a plot of land, and you have a guy who wants to buy that land and develop it. He goes to his buddy who has a lot of money, or who knows somebody with a lot of money, and says, look, you give me $100, we'll go buy this piece of land for $100. We'll take a loan out for another $100, and we'll go sell it for $300. That's your average development project. I mean, granted, you add a bunch of zeros and that's what it looks like, right? That's the goal. And there's several things that can go wrong during that goal. If everything goes well, my phone never rings, and you guys make a ton of money, and everybody lives happily ever after. Where my phone rings is, it's always two things: either there's too much money or too little money being made. You know, too much money is somebody's like trying to get away with something that they shouldn't have gotten away with. Those are good problems to have, and usually they don't wind up in court. They wind up in some type of a settlement. Too little money is usually where people are mad. Right. And what happens is the average construction project goes wrong for two or three reasons. One, cost of construction. Two, length of construction. And three, the price is not what they thought it was. Those are the main reasons why something goes wrong. Now, when you have low interest rates like we've seen historically, what you see is asset appreciation still makes everybody whole. So, you know, the cost of construction wasn't $100, it was $200. Interest rates are low. It took an extra 12 months to finish the project, but interest rates were low, so we weren't hurt so bad on the interest portion of the program. But look, the asset didn't sell for $300, it sold for $450, so we made as much money as we thought we were. We're still the smartest guys in the room, right? No foreclosure issue, no issue between the partners. Everybody makes money and everybody's happy. Now, as interest rates creep up, what you see is the opposite being true. You start to see, and we're starting to see, asset prices coming down. You start to see the projects sitting on the market longer in order to be sold. You start to see less activity in the market, but to be fair, you see less. You know, like the earlier gentleman was saying, cost of construction is starting to go down as well. So what I look at when I look at this, I say, okay, well, we're at 6.8% interest rates. We're near that historical average. And if you were to study this data a little bit more, you'd see there's about a 2 to 3 year lag between higher interest rates and more foreclosures and more bankruptcies. So when I look at this, I ask myself two questions. I'm like, okay, well, we should start over the next 2 to 3 years, next year, start seeing additional bankruptcies. And the second thing that I think is very interesting is to play armchair quarterback, is to ask yourself, okay, if we can prognosticate about what's happening, and I love to do this, I'm happy to do this. I don't know if you guys have already done this already, but somebody has to be sitting there saying, well, what's going to happen with interest rates? Because that is probably the best indicator, especially in a real estate driven market like Southern California. That's going to be the best indicator of where the market is going and what people are going to be doing. And that's borne out with the data, at least historically.
That's really good. Yeah, because I didn't think about it that way. And actually, I think we'll stop there, AJ, because we're up on time. But for me, this was really good because, I mean, that's crazy. We knew the number about foreclosures, 216 last year. That's very, very little. But the bankruptcies are lower. So you're thinking this year, you would say you're going to see more business on the bankruptcy side.
I'm saying on the litigation side right now, we're as busy as we've ever been. Part of that's because we're doing better work and we've got better, systems and processes in place. But even without that, like we're as busy as we've ever been. I attribute a lot of that to the lack of availability of free money. I mean, what we saw over the last 3 years was unprecedented. Last year, I think I had a slide in here that said, I think I wrote out what is $8 trillion. And if you actually look at it on a piece of paper, it's an astronomical sum of money that was pumped into the economy. And so, right now what we're seeing is, there's no more idle loans, there's no more ERC money, there's no more PPP money that's available. And so people are basically, the businesses that probably should have failed a while ago are now starting to pull up the stakes. The free money to buy out other businesses that were struggling isn't available. And so we are starting to see a return to what I would consider to be historical norms. If interest rates stay around 6%, I think we are going to see a return to foreclosures similar to what we saw from 2000 to 2005. I just don't think we as people have been like involved with the market and have that level of longevity to remember what was it like at 6% interest or 7% interest. We just don't understand it.
Right. Okay, that makes sense. And then the last question before we jump off here for you, AJ, is if you had $1 million, where would you place it?
Yeah, I mean, it depends. Everyone's risk tolerance is different, right?
No,
I think
you.
it's different if you're
What would
80
you-
and if you're for me personally, I mean, I'm a big believer in just parking in the S&P and waiting for it to grow. I mean, it grows at 7% historically year over year, and you don't pay any taxes on it. I agree with a lot of what you're saying though, is leverage through a mortgage. If you don't own a home, you have to go. If you don't own your residence and you've got the money for a down payment, there's so many advantages to buying a home, being able to write off interest, being able to have stability. There's so many advantages to owning a home. That's where you go. I think for investment purposes, it's tough, man, because the ROI on your money is you're betting, you're betting on the come. And it's a tough call. I think it's
Yeah.
a tough call. You're
Okay,
getting
well,
5% at the bank.
yeah. Well, I mean that's a good answer though. 7% S&P, that's your answer, and that's a good segue to our next guest and our final guest. We're gonna wrap it up. AJ, thank you so much for joining us tonight, man. Appreciate you. And enjoy the rest of your night, man. Thanks for
All right,
putting this
cool, buddy. Yeah, no, glad I could participate, and I apologize for not being able to be visual. So,
It's all gravy, man. All right.
all right,
I'll
later.
see you later. All right. Cool. Eleazar, let's introduce our next guest. Very excited. Philip Simmons, wealth strategist. Philip has over a decade of experience in the financial services industry. He holds a Series 7 and 66 license, and he's earned his MBA in entrepreneurship and innovation from Point Loma Nazarene University. That's the best views in the country right there. And has a Bachelor of Arts in Economics from the California State University in San Marcos. Welcome, Philip. Thank you for joining us late night. We're wrapping up here.
Yeah, absolutely, Voltaire. Thanks so much for having me. It's always a pleasure being on this program. And I have to say, you guys are dedicated to wanting to learn something new every day. And this is a testament to that. Look, I'm not going to make this too long, as I know we're getting up on the hour here. Me and Voltaire go way back. We work well together, and he's actually helping me personally right now. So kudos to his team. If you haven't worked with Voltaire and his team, you should definitely look into that. They can definitely get you set up and get you going in the right direction.
Thank you.
So as Voltaire mentioned, my name is Philip. I'm a financial planner, advisor, wealth strategist, you name it. Really focused on markets and really helping people grow their overall estate. Not a lot of people talk about not a lot of people talk about estates when talking about financial planning. It's usually about dollars and cents, but there's a lot more that goes into it, as you heard from some of the attorneys on the call here. I'm going to share my screen real quick, and we're just going to go through a brief presentation. I want to talk about where we've been in the market, where we are, where we possibly could be going in the next 6 months. Unfortunately, my crystal ball still has COVID, even after the 4th vaccine, so I won't have a clear picture as to what that looks like here in the near future. So as Voltaire mentioned, um, can you guys see this? Nope, see this is the oh, there it goes. Can you guys see that?
Quarter 4, 2023.
Perfect. 2024, yeah. Okay. So like Voltaire mentioned, look at staying educated is the biggest thing the best thing you can do, no matter what source that is coming from. Get as much information as you can to make those educated decisions for yourself. One of the things I want to share with you as far as education is where we've been in the financial markets. We typically in our office will track the S&P 500 index. Why? Because it's the top 500 companies in America, and they do their own vetting year over year over year. So to AJ's point, the market, the S&P 500 index has had one of the better averages over the long term. Actually, since its inception in 1957, it has averaged roughly 10% per year on an annualized average. Taking a look at what we did last quarter, I think one of the speakers had talked about the euphoria around what the Federal Reserve may be doing here in 2024, and that's rate cuts. So in the last quarter of the year, albeit it was a tremendous year to many people's surprise, this fourth quarter really showed the strength as to where interest rates and how the Fed has been kind of dictating what financial markets are doing this past year and year and a half. So this is just the fourth quarter in the S&P here on the left, the Dow Jones on the right. You can see that rate of return just if you invested in October 1 to the end of the year. I mean, you would have already eclipsed double digits. Looking at the year as a whole, this chart I think is very important. And one of the reasons I'm bringing it up is because it's a hallmark to what every financial advisor should be telling clients is you need to stay the course. Investing is, as you have heard from all these real estate experts, it is a long-term game. In our world, investing just in the S&P 500, if you would have done that at the beginning of the year, and maybe you got out in March because you thought things looked dismal, or maybe you got out at the end of October because you thought everything was beginning to crash from highs, well, you would have missed out on quite a bit of opportunity here going forward. So this chart, like I said, really kind of depicts what the reasons for investing long term really mean. As far as what we did have happen last year, we broke out into another war. So we now have two wars that were running in 2023. You had a Federal Reserve who was under the microscope because they were artificially pushing up interest rates through the better part of 2022. And that was really because you saw this huge increase in the cost of capital or inflation. Inflation pushed up everything and made more goods and services expensive beyond many Americans' needs and means, excuse me. But as that started to steady, and the reason that steadied is because companies like the top 500 companies in America began to make changes within their own environments. For instance, you heard a lot of layoffs had happened. Now, layoffs are terrible for the individual. Maybe some of you have experienced it. But when it really comes to an investing standpoint, layoffs are great for the financial markets because what it is it's companies tightening their bottom line and tightening their budget, meaning they will be more profitable as their continued source of revenues continue to generate. So one of the things that happened here last year, as you can see by the chart, is inflation skyrocketed to levels we haven't seen in over 40 years. And if you don't already know, the reason this became such a huge deal is because it most notably impacts consumers. And consumers drive over 72% of the economy, which translates into GDP or gross domestic product. So if 72% of our economy is being dictated by the consumer and the consumer is being weighted down by just the hyper cost of goods and services, well, then they stop spending. And much like you saw that happen in the market in 2022. Not only did individuals slow down their spending, but they also began to slow down investments. And that is real estate builders, even the government and businesses all began stopping their investments because their expenses were so high. We saw this begin to drop in 2023, and that alluded to the story of why the Federal Reserve began to have the conversation around pausing interest rates. They began pausing interest rates at the March meeting of 2023, had another increase in June, and then paused the rest of the year for 2023. And that presented the optimism for most investors heading into this new year. Now, where are we going in this new year? Oh, let me talk about the interest rates. So this is a chart going back to the early 2000s, what we as financial advisors always call post.com, because pre-internet, there was a lot of different things happening in the financial markets, but post-internet, as quickly as things can move, here is where the federal funds rate, or what you more commonly know of, is the interest rates that the Federal Reserve has continued to push higher. So in a very short period of time, interest rates were artificially pushed again to 40, almost 40-year highs. And that was a shock to the market, which is why we saw the sell-off in 2022. The rebound, as I had noted in 2023, was because that little part at the very top there, you see how the interest rates just flatline. Well, that's the Federal Reserve saying we're no longer going to increase interest rates, or the federal funds rate. Just a little context on the federal funds rate. It is actually the rate at which banks borrow money from one another. Okay. It's the rate at which banks borrow money from one another, and that helps lending and so forth, and trickles down to the consumer. So that's where we were in 2023. The Federal Reserve began pausing on interest rate hikes because they saw an unemployment rate that was strong. They saw jobs continuously being created at about 200,000 clip per month, which is about average. We had some spikes of maybe 500,000 in May. We saw some spikes of 300,000 in the early parts of the summer. All of that mixed up, added to the confidence of the Fed having this quote unquote soft landing. And that's where we bring ourselves to today. Where is the Federal Reserve going to go from here? That is to be determined. I think Dr. David Fogel said it best with using the betting odds that do show up for our research. 95% believe that we're just going to hold rates steady in this first meeting, which we all believe that is to be true. Where the conversation is, or the euphoria, optimism, however you want to chart it, is coming from is in the fourth quarter of 2023, the Federal Reserve talked about cutting rates as soon as March. Many had already priced in a rate cut in June, but the conversation began to come in March simply because the unemployment rate remained around 3.2, 3.3%, as well as job creation began to proliferate across the board. But again, we still don't know. We don't know what the Fed is going to do. They are, quote unquote, this non-government entity. However, we know how that can play in the hands of political figures. So we do expect quite a bit of volatility this year, as we have a presidential election. We have two wars going on, one that is now cramped the Red Sea. There's a lot of activity going on over there that will impact oil prices down the road. And then we have, of course, the Federal Reserve, who is deciding whether or not to cut interest rates in March or June or any of their other meetings this year. I talked about the geopolitical environment, which is one of the reasons why at our office here at ATS, we stay invested in the US. Now, there's not to say there is a place for international markets in your portfolio, but we would advise looking into companies who have international tentacles. That seems to mitigate a lot of the geopolitical risk that we are facing today. Now, the political risk in America, that's not as easy as to sideswipe when you're talking about investing. But nevertheless, the volatility and buying good, solid companies that have weathered multiple storms is a surefire way to stay prosperous in the financial markets. So one of the things, again, I had wanted to mention, go back here. Sorry about this. Long-term investing. Look, at the strategy we have, and the strategy I can give you all, is investing in the financial markets is a long-term game. Nobody in our office and who we work with is about trading or shorting the market. That is, it honestly takes extremely a lot of man hours and a lot of work to try to play that game. And really you're playing chicken. Because just as quickly as it can swing up, the market can swing down. So remain steadfast, do not panic. We've all seen the story before, and remain long term in your investment strategy, and that's really where you're going to garner the best rate of return. So, like I said, I'm going to keep this short, but in summary, inflation is slowing, and it's slowing enough that the Federal Reserve is considering cutting interest rates. Nevertheless, it is a concern because now you have this cramp in the Red Sea, which will increase oil prices. And a part of that inflation story comes from energy, and energy is derived from oil. Possible interest rates cuts in 2024. There's been a lot of different conversation about are they going to do 2 rate cuts, 3 rate cuts, 4 rate cuts? Again, that remains to be seen because the Federal Reserve is very committed to being data dependent. It's not until we have actual data that we can determine their course of action, or at least the best guess, if you will. Volatility will remain. One of the things that people should understand is, and our research actually did show, although the market or the financial market does average about 11% each year of presidential election years going back to 1928. Anytime you see law changes across a headline or somebody positioning themselves to change tax law, estate planning laws, anything that's going to impact individual and the wealthy, you are going to see the market move, and it may move negative. But if the tax law change is going to help, then it may move positive. So understand that volatility is going to come because we are in a political environment. There is a lot of occupation going on over in the around the world. So just be prepared for that. The soft landing is more likely than the recession. That was a huge conversation in 2023, and pretty much every financial expert was wrong. The recession did not come, and we are more likely to have this soft landing than anything. Again, stay the course, remain long term, and be well prepared. Like coming on these programs that Voltaire has been hosting for a very long time, educating yourself helps to prepare you for what's to come, even though it's unknown. And with all that, I will take some questions.
Cool, let's do that. Thank you so much. So a quick reminder to everyone, if you haven't already, whoever invited you, whichever Lepe Tendwell real estate agent invited you, please go and rate them. Give them a 5-star review with positive comments. It really helps all of our business. There's some links in here. And if the link for your realtor isn't on here, please ask them for the link and thank them. One question I have right off the top is, how many clients do you guys service? And ballpark, you talked about estate. What's the most the wealthiest estate that you guys actually like have as a client?
So our office manages a little over 400 families. The reason I say families because we are in the business of estate financial planning, which varies a little bit because we deal with multiple generations. So yes, that does include grandma, grandpa as one family, kids and all their kids as a separate family, and then all their grandkids as separate families. The biggest estate, I mean, we have a couple clients north of 100 million. But that is a very small handful. Most of our clients are in the realm somewhere between 5 to 25 million as far as their entire estate.
Nice. So, and I want to know, because I'm curious, and I'm like, that excites me, that type of money. But at the same time, it's like, hey, if we have a $50,000 or 10,000 to our name or 100,000, dude, this is the guy, Philip, that's talking to these families and giving them the same advice. So just so everybody has that context, like, hey, this is like really good stuff. So that was one. I have another question about I think I know what you're going to say, but if someone gave you $1 million, where would you place it right now?
I'd place it in the financial markets.
Okay, cool. In the stock market, just to be
Yeah,
clear.
the stock market.
Stock market. Cool.
Yeah.
Perfect. All right. Any questions for Philip before we wrap this up? It's been an awesome night. And what I'm taking away from it, because I have a bunch of notes, I've been writing notes this entire night, is if we want to make money, we have to invest our money. Okay. So what we practice and preach at our office is very simple. 20% of any income we make, we put it away and we invest it in something, right? So it could be the stock market,
So
it could be real estate, but you have to invest 20% of all your earnings ever. And then with the other 80%, you pay all the bills. You're going to answer that question more thoroughly, Philip?
Oh, well, I was just going to say, I had a question pop up in here. What stocks would you invest in? For first-time investors, I'd say look around your house, look where you shop, look what you buy. One thing that we talk to our clients about, it's easier to understand investing and what you're invested in if you actually own those things. For instance, one of my favorite stores is Home Depot. I actually just went to Home Depot while I was listening to everybody to buy a few different ceiling fans. So I buy Home Depot. Not saying that's a good or bad stock. I'm just saying that's what we do. I've done individually. But when it comes to investing, you first rule, don't invest money if you don't have money. If you can't make your cash flow work, if you are spending more than you're making, you can't invest. If you're using credit cards and you have credit card debt, that's a negative return. Don't invest. You need to pay the debts off or learn to leverage those debts more appropriately. I think one of the gentlemen talked about doing a HELOC and wrapping it all up and consolidating things like that. That is appropriate. But before you begin investing, make sure your cash flow is tight. You have more flexibility, more investment options when you have positive cash flow.
That's a great great advice. And by the way, we have the calendar if you want our calendar for the rest of the year for all our workshops, go ahead and we'll send you an email. We have everyone's email, right, Eleazar? But they're really good, and that's exactly what we teach. What Philip just said, we teach a budgeting class where we show you how to get rid of debt. Now we have money to invest. So yeah, thanks for that. And you said look around for household items, whatever you spend your money, that's where you should be investing first, for first-time buyers. I mean, first-time investors. I like that. So I hope that everyone increases their wealth in 2024. I wish you nothing but the best. If you want any information on any of the speakers tonight, please reach out. We'll connect you. And because we believe in these guys, we use these guys. And I did try to get some women on, but I had no luck to do that because I have some women friends that make a lot of money and advise a lot of people. But tonight it's just a bunch of guys. So thanks for joining us. We'll see each other later. Peace out.
Thank you, Voltaire.
Thank you.